Hello and welcome to another video on trading. Today we'll be looking at candlestick patterns, which are essential tools for Forex traders who rely on technical analysis. They not only help in analyzing market trends, but also serve as a foundation for using other indicators, as well as analytical tools. In this video, we'll break down the key concepts and types of candlestick patterns, so let's dive in. Firstly, let's have a look at what a candlestick is. So, a candlestick visually represents price movements within a specific time frame, which can range from seconds to months. Each candlestick shows 4 key price points: the opening price, the closing price, the highest price, and the lowest price. This simple yet powerful tool helps traders identify potential trends and market sentiments at a glance. Candlesticks are made up of 2 main parts: the body and the shadows. The body is the rectangular part of the candlestick and shows the range between the opening and closing prices. If the closing price is higher than the opening price, it is called a bullish candlestick, often represented in green. If the closing price is lower than the opening price, it is called a bearish candlestick, and it is typically shown in red. The shadows, which are the lines extending above and below the body, represent the highest and lowest prices within the selected time frame. The upper shadow extends from the top of the body to the highest price, while the lower shadow extends from the bottom of the body to the lowest price. These shadows provide valuable insights into market pressure during the time frame. Next, let's explore the different types of candlestick patterns, starting with single candle patterns. They are formed by just one candlestick and offer valuable insights into market sentiment as well as potential trend changes. They are often used to identify market indecision or the presence of strong buying or selling pressure. For example, a standard doji is a candlestick with a small or no body, where the opening and closing prices are almost identical. This pattern typically signals market indecision and suggests that a trend might either continue or reverse. Another common pattern is the gravestone doji, which has a long upper shadow and no lower shadow. This suggests that sellers have overpowered buyers, signaling a bearish trend. On the other hand, a dragonfly doji has a long lower shadow and no upper shadow, indicating that buyers have overpowered sellers, which can signal a bullish reversal. A hammer is another crucial pattern. It is a small-bodied candlestick with a long lower shadow that forms at the end of a downtrend, indicating a potential bullish reversal. In contrast, a hanging man is similar to the hammer but forms at the end of an uptrend, signaling a bearish reversal. There's also the inverted hammer, which has a small body and a long upper shadow, appearing at the end of a downtrend and often signaling a bullish trend. Conversely, a shooting star is similar to the inverted hammer but forms at the end of an uptrend, suggesting a bearish reversal. The spinning top is a candlestick with a small body and long shadows on both sides, which indicates market indecision. This pattern often suggests a potential trend reversal. A marubozu is a long-bodied candlestick with no shadows, indicating strong buying or selling pressure. A green marubozu is a bullish signal, while a red one suggests a bearish trend. Now let's dive into two candle patterns. These patterns are formed by consecutive candlesticks and are useful for identifying the direction of the market. One of the most important two candle patterns is the engulfing pattern. It occurs when a large candle completely engulfs the previous smaller candle. A large green engulfed candle signals a bullish trend, while a large red engulfing candle signals a bearish trend. Another two candle pattern is the harami, where a small candle is contained within the body of a larger previous candle. If the second candle is green, the pattern signals a bullish reversal. If it is red, it signals a bearish reversal. The piercing pattern forms in a downtrend when a green candle follows a red candle and closes above its midpoint, suggesting a bullish reversal. On the other hand, the dark cloud cover pattern forms in an uptrend when a red candle follows a green candle and closes below its midpoint, indicating a potential bearish reversal. Finally, let's take a look at multiple candle patterns. These patterns involve 3 or more candles and generally provide stronger signals about market trends and potential reversals. One such pattern is the morning star, which consists of a strong red candle followed by a gap up and a small bodied candle, and then a strong green candle. This pattern signals a bullish reversal. The evening star is the opposite, starting with a strong green candle followed by a gap up, a small bodied candle, and then a strong red candle. This suggests a potential bearish reversal. The 3 white soldiers pattern consists of 3 consecutive long green candles, each closing higher than the previous one, signaling a strong bullish momentum. Similarly, the 3 black crows pattern consists of 3 consecutive long red candles, each closing lower than the previous one, indicating strong bearish momentum. By now, I hope I have shown you that candlestick patterns are an invaluable tool in technical analysis, providing traders with a visual and intuitive way to assess price movements and market sentiment. By familiarizing yourself with different candlestick patterns, you'll be better equipped to anticipate potential trend changes and make more informed trading decisions. Whether you're new to trading or a seasoned professional, incorporating candlestick patterns into your strategies can significantly enhance your analysis skills and improve your trading outcomes. I hope you have learned a lot from this video and that you'll join us in learning more about trading with our next video. See you then, and best of luck.